Stop what you're doing. If you own or follow the software sector, you absolutely need to hear this fundamental breakdown. We've all experienced that terrible sinking feeling in the pit of your stomach, right? You check your portfolio and watch a supposedly bulletproof tech stock plunge 22% almost overnight. It's terrifying, but here is the truly shocking part about this one. This specific company didn't suddenly lose its fundamental strength. We're talking about a business that still boasts massive 79.2% gross margins and an incredibly sticky 94% recurring revenue rate. So that begs a really bold question. Are we staring down a classic value trap that's about to drain your portfolio, or is the broader market just severely overreacting to a necessary routine business cleanup? It's kind of like finding a fortress on sale just because a window cracked. By the end of this explainer, you are going to know exactly what caused the sudden crash. We're going to give you a clear framework to see whether their economic moat is genuinely an impenetrable fortress or if those walls are actually starting to crumble. Welcome to the explainer. Today, we are taking a highly structured, fundamental deep dive into SPS Commerce, ticker symbol SPSC. If you aren't familiar, they are an absolute titan in the cloud-based supply chain management space. We're not here to get caught up in the daily market noise. We are going to strip all of that away. We're looking directly at the raw fundamentals, analyzing their competitive landscape, and unpacking the massive strategic pivots management is executing right now. We're talking about real, actionable analysis of a company trying to dominate global retail connectivity. Let's dive in. Here is our roadmap for the analysis. Section 1, the supply chain chaos. Section 2, SPC's network moat. Section 3, measuring the financial engine. Section 4, navigating the Amazon headwinds. And finally, Section 5, future-proofing with AI. Okay, starting with Section 1, the supply chain chaos. We really need to understand the high cost of retail inefficiency. Think about this for a second. What is the true cost of supply chain chaos? When a retailer or supplier gets their inventory wrong, it's not just a minor operational headache. It is a massive, direct hit to the bottom line. If a product is out of stock, obviously you lose the sale and damage your brand reputation. But what if you overstock? Well, then you're hit with inventory carrying costs. We're talking about expensive warehouse space, employee wages, and product expiration. On average, carrying costs eat up a staggering 20 to 30% of a company's total inventory budget. That is literally trapped capital that could and should be used for growth. Now, these essential inventory KPIs, like the stock-to-sales ratio, inventory turnover, and demand forecast accuracy, they act as the vital signs for a retailer's health. And here's the catch. They rely entirely on clean, fast data flowing between the manufacturer, the warehouse, and the retail shelf. If you have bad data here, your stock just sits idle and your capital is trapped. The market has been screaming for a unified solution to coordinate all of this care. That brings us to Section 2, SBC's network moats and how they are dominating retail connectivity. The crucial point we need to focus on is this massive number, 115,000. That is the number of trading partners currently connected to the SPS Commerce cloud-based network. They aren't just selling a basic software tool. They had built a massive, deeply interconnected ecosystem of retailers, suppliers, logistics providers, and brands. And that sheer scale, it gives them an estimated 25 to 30% market share in the retail electronic data interchange, or EDI segment. Because they are a pure-play, best-of-breed software model tailored specifically for retail, they are able to compete fiercely and actually win against massive enterprise giants like SAP and Oracle, who usually just bundle their supply chain tools into much broader, clunkier software suites. What's brilliant is that this dominance is protected by a textbook definition of the network effect. Every single time a new supplier or retailer joins the SBS Commerce network, the platform becomes exponentially more valuable to everyone else already on it. With over 32,000 pre-certified connections, onboarding is lightning fast. This creates immense switching costs. Once a company's plugged in, leaving is incredibly painful. This defensible moat directly translates into a highly predictable business model driven by an impressive 94% recurring subscription revenue. That kind of stability is exactly what you want to see. Let's move to Section 3, measuring the financial engine. It's time to unpack the numbers. When we compare the fundamentals, the story gets really interesting. For 2026, SPS Commerce is projecting a revenue midpoint of around $799 million. That represents about 6% year-over-year growth. But the real star of the show is that gross margin, 79.2%. That significantly outpaces the broader tech SaaS index median of 75%. This tells us definitively that they have an incredibly efficient core engine.
the cost to service an existing customer is just incredibly low compared to the revenue they generate. That gives management a massive war chest of cash to constantly reinvest back into the business.
And this dynamic perfectly illustrates the broader market context right now. Referencing data from the Objective Investment Banking H1 2025 industry report, we can clearly see that across the software industry, strong, stable gross margins are commanding incredibly resilient valuations. High-growth, high-margin companies are exactly what investors want. So fundamentally speaking, SPSC's core engine is operating at a premium tier. But if everything is so rock solid, why did the stock drop 22%?
That leads us into Section 4, Navigating the Amazon Headwinds and Understanding that 22% Plunge.
So the company operates a revenue recovery segment. Essentially, they help clients reclaim money that gets lost to supply chain errors. Recently, they acquired a company called Carbon6 to quickly expand this service into the massive Amazon and Walmart ecosystems. But there's a structural shift happening. While SPC's core business continues to grow at healthy high single digits, they are completely overhauling the pricing for their Amazon third-party cohort. They are introducing a new $19.99 per month platform fee to offset infrastructure costs for these smaller, low-revenue accounts. Because of this new fee, management is openly projecting they will see up to 4,000 customers churn in 2026. Now, management expects this to be essentially revenue neutral overall, but this turbulence, combined with some general tech budget caution, really spooked the market. And right in the middle of this turbulence, an activist investor entered the fray. Anson Funds Management recently disclosed a stake in SPS Commerce and has actively begun pushing the company to explore strategic alternatives. That includes a potential sale and management changes, arguing that the stock price has lagged competitors. Now, as an objective explainer, we absolutely aren't taking or endorsing either side here. However, it is absolutely crucial to understand that this activist pressure adds a serious layer of complexity and heightened scrutiny to the company's near-term strategic decisions. Finally, Section 5, Future-proofing with AI. This is the next era of the supply chain. Remember those massive gross margins we discussed earlier? Well, this is exactly where that money goes. In 2024 alone, SPS Commerce poured $105 million into research and development. In a highly competitive landscape where smaller startups and ERP giants are constantly trying to innovate, this massive capital deployment is how SPS intends to keep its moat wide and deep. A major focus of that R&D is a new AI agent named Max. To see how this actually works in the real world, let's look at a customer case study mentioned by CEO Chad Collins regarding Siete Foods. Siete is scaling rapidly into massive retailers like Walmart and Target. They are currently using Max to instantly diagnose why shipments fail or invoices get rejected long before those issues impact their retail partners. It's shifting SBPC from just being a dumb connection pipe to being an active, intelligent layer in the supply chain that literally protects supplier revenue. Internally, they call this agentic engineering velocity. And I know that sounds like a buzzword, but it's driving serious, measurable operational improvements. AI is reducing customer onboarding from weeks down to days. MAX is proactively catching expensive errors. And commercially, these advanced analytics are incredible upselling tools. Right now, SPC averages about $13,550 in revenue per customer annually. By integrating these AI-driven insights directly into daily operations, they are strongly positioning themselves to significantly expand that average revenue per user over time. Which leaves us with the ultimate question. Will SPC's massive 115,000 partner network moat and their deep AI innovations outpace the current headwinds we're seeing in their Amazon segment? Management is certainly confident. They are deploying almost 100% of their free cash flow to repurchase shares, backed by a massive $300 million buyback authorization. So, is the 22% plunge a severe overreaction to a necessary business model cleanup? Or is it the first real crack in the armor? It's a fascinating tension, and their next earnings report is going to be absolutely critical to watch.